Ladies and gentlemen, right now something extraordinary is unfolding in the precious metals world, and if you hold silver or gold, you must pay attention. A seismic shift is rattling markets. A wake-up call is sounded, and right at this moment, the price dynamics of silver are screaming an alert that every holder, whether you're stacking for retirement, inflation protection, or generational wealth, cannot afford to ignore. Right now, the market is sending a very clear warning signal, and most people are either ignoring it or completely misunderstanding it. This is not noise. This is not hype, and this is not one of those short-lived price spikes that disappear as quickly as they arrive. What we are seeing in silver is the type of behavior that typically shows up before major repricing events, not after them. The urgency isn't coming from social media excitement or emotional traders. It's coming from the structure of the market itself. And that's what makes this moment so important. Silver has quietly transitioned from a sleepy, underperforming asset into one of the most aggressively moving metals in the financial system. When markets do this, they are not asking for permission and they are not waiting for headlines to catch up. Price always moves first and explanations come later. The recent acceleration in silver price is a classic example of capital rotating with intent, not speculation, but positioning. Large players don't chase price for fun. They move when risk to reward shifts in their favor. And right now that shift is clearly underway. What really stands out is the speed of the move. Slow, gradual price increases are easy to dismiss. Sharp, persistent moves are not. Silver is pushing through levels that previously acted as ceilings, and it's doing so with strength, not hesitation. That tells us the selling pressure that used to cap price has been absorbed. When that happens, the market enters a new phase, one where upside exploration becomes a priority. This is exactly how early stages of major trends begin, and they almost always feel uncomfortable or unbelievable at first. The reason this matters so much is because silver doesn't move in isolation. It acts like a pressure valve for the broader monetary system. When confidence in paper assets starts to wobble, silver tends to respond earlier and more aggressively than gold. That's not an opinion, it's a historical behavior pattern. Silver is smaller, thinner, and more sensitive to shifts in capital flows. So when silver starts waking up like this, it's usually a sign that something larger is changing underneath the surface. This is where the urgency comes in. Many investors wait for confirmation from the news, from analysts, or from price targets that feel safe. By the time those confirmations arrive, the easy part of the move is already gone. Markets reward preparedness, not reaction. The current setup in silver suggests that we are still in the early stages of awareness, not the late stages of euphoria. That window does not stay open forever. Talk of extreme price levels, whether it's $1,000 or even $7,000, isn't the real story. Those numbers grab attention, but they're not the point. The point is why people are even discussing such possibility. Extreme projections only emerge when markets start to recognize deep imbalances between supply and demand, between real assets and financial promises, between risk perception and reality. When those imbalances exist, price doesn't move politely, it moves decisively. Another critical factor is positioning. Many investors remain underexposed to silver because it has been frustrating for so long. Years of sideways movement condition people to stop paying attention. That creates a dangerous situation when momentum returns because it means there's very little resistance on the way up. Fear of missing out doesn't start at the bottom. It starts after the breakout. We are approaching that zone now where disbelief begins turning into forced participation. This is why gold and silver holders must pay attention now, not later. Silver doesn't give long warnings. It compresses, coils, and then releases energy rapidly. When it moves fast enough to leave unprepared investors chasing instead of positioning. The market is already signaling that something has shifted, and ignoring that signal is a choice, one that often comes with regret. The key takeaway is simple. This is not about predicting an exact price. It's about recognizing a regime change when it begins. The alert isn't the number, the alert is the behavior. And right now, silver's behavior is flashing bright, unmistakable signals that demand respect, awareness, and strategic thinking before the next phase fully unfolds. What's happening beneath the surface of the silver market right now is far more important than the daily price swings people focus on. Price is only the symptom. The real story is the growing structural imbalance that has been building quietly for years. Silver is one of the few assets where supply and demand dynamics are no longer theoretical. They are measurable, persistent, and increasingly difficult to ignore. And when markets reach this point, repricing becomes a matter of timing, not speculation. Silver supply is not flexible. That's the first issue most investors underestimate. Unlike paper assets or even some commodities, silver production cannot be ramped up quickly in response to higher prices. Most silver is mined as a byproduct of other metals like copper, lead, and zinc. That means even if silver prices rise aggressively, miners cannot simply decide to produce more silver unless it aligns with broader base metal economics. This creates a bottleneck that limits responsiveness at exactly the wrong time. At the same time, demand is becoming less optional and more structural. Silver is no longer just a store of value or an investment metal. It has become an industrial necessity. Solar panels, electric vehicles, advanced electronics, medical technology, and data infrastructure all rely on silver's unique conductive and thermal properties. These industries are not cyclical in the traditional sense. They are part of long-term global policy and technological transitions. When demand is policy-driven and technology-driven, it doesn't pull back easily, even during economic slowdowns. This is where the imbalance intensifies. On one side, you have constrained supply that cannot expand meaningfully. On the other side, you have demand that is not only growing but accelerating over time. The gap between the two widens and the market is forced to reconcile that gap through price. Not gradually, not gently, but decisively. That's how commodity markets restore equilibrium when physical availability becomes an issue. Another overlooked factor is inventory drawdown. Global silver stockpiles have been steadily declining as industrial users consume more metal that is being replaced. Inventories act as shock absorbers in commodity markets, and when those buffers thin out, volatility increases. It doesn't take a crisis for price to move sharply. It only takes a small disruption when inventories are already tight. This is why silver tends to experience sudden, powerful moves instead of smooth trends. Investors often assume that demand destruction will cap prices. That logic works for discretionary commodities. It does not work the same way for silver. You can postpone buying jewelry or luxury goods, but you cannot redesign power grids, solar installations, or electronic supply chains overnight to eliminate silver. Substitution is limited, costly, and inefficient. That gives silver pricing power the market has not fully priced in yet. This is also why price suppression arguments tend to fall apart over long time frames. Paper markets can influence short-term price behavior, but they cannot manufacture physical supply. Eventually, physical demand asserts itself. When it does, paper pricing mechanisms are forced to adjust or break. History shows that when physical shortages emerge, futures markets lose control faster than most people expect. The urgency for investors comes from understanding where we are in that process. Structural imbalances don't resolve in straight lines. They build quietly, then suddenly reach tipping points. The early warning signs are already visible: persistent supply deficits, rising industrial consumption, shrinking inventories, and renewed investor interest layered on top. When investment demand returns to a market already struggling to meet industrial demand, the pressure compounds quickly. This is why discussions around extreme upside scenarios even exist. They are not predictions pulled from thin air. They are stress tests of a system under strain. When analysts model scenarios where supply fails to meet combined industrial and investment demand, prices escalate rapidly in those models because there are very few release valves. The system doesn't have room to breathe. For gold and silver holders, this isn't about chasing excitement. It's about recognizing that silver's role in the global economy has changed permanently. It is no longer just a monetary hedge. It is a strategic material. Markets tend to underprick assets during these transitions because old frameworks no longer apply. By the time new frameworks are widely accepted, prices have already moved. The key is awareness, understanding that this is not a short-term trade driven by sentiment, but a long-term repricing driven by necessity. Supply constraints don't announce themselves loudly. They show up gradually, then all at once. Silver is approaching the stage where the imbalance becomes impossible to smooth over quietly. The broader macroeconomic environment is quietly aligning in a way that historically favors hard assets, and silver is sitting right at the center of that alignment. This isn't about a single data point or one economic report. It's about a gradual shift in how capital responds to uncertainty, policy decisions, and long-term confidence in the financial system. When these forces begin to converge, markets don't move randomly. They move with direction, and they tend to reward assets that exist outside the traditional financial structure. One of the most important drivers right now is monetary policy fatigue. For years, markets have been conditioned to expect intervention, stimulus, and support whenever stress appears. That expectation is slowly eroding. Central banks are constrained by debt levels, by political pressure, and by that refuses to fully retreat. Even when interest rates pause or begin to decline, the underlying issue remains. Real rates struggle to stay meaningfully positive. In that environment, holding cash becomes less attractive, and capital naturally looks for assets that preserve purchasing power. Inflation doesn't need to be out of control to be dangerous. Persistent, uneven inflation is often more disruptive than short spikes. It distorts pricing, compresses margins, and erodes confidence quietly. When people begin to realize that inflation is not a temporary inconvenience, but a structural feature of the system, behavior changes. That shift in behavior is what benefits precious metals. Silver, in particular, reacts strongly because it straddles both monetary and industrial demand, making it sensitive to inflation from multiple angles. Currency dynamics also play a major role. When major currencies weaken relative to real assets, it's rarely obvious at first. It shows up as volatility, then as trend, competitive devaluation, rising fiscal deficits, and expanding balance sheets all undermine long-term currency strength. Investors don't abandon currencies overnight. They hedge gradually. Precious metals become a natural destination for that hedging process, especially when trust in policy consistency begins to fade. Geopolitical uncertainty adds another layer of pressure. Fragmentation of global trade, reshoring of manufacturing, and resource nationalism all increase costs and reduce efficiency. These shifts are inflationary by nature. They also increase the strategic value of physical commodities. Silver benefits directly from this environment because it is embedded in critical infrastructure and technology. When global systems become less cooperative and more defensive, tangible assets gain importance. Another factor often overlooked is debt sustainability. Global debt levels have reached a point where traditional normalization becomes difficult. Higher interest rates increase servicing costs while lower rates risk reigniting inflation. This creates a narrow policy corridor with little room for error. Markets sense this tension long before it becomes visible in headlines. When confidence in long-term debt management weakens, demand for non-liability assets increases. Silver does not rely on someone else's promise to pay, and that matters more as debt loads expand. Equity markets, despite their strength, are increasingly concentrated as a small number of stocks carry a disproportionate share of market performance. This concentration increases fragility. When leadership narrows, diversification becomes more valuable. Precious metals often re-enter portfolios during these phases, not as speculation, but as risk management. Silver's volatility can be intimidating, but it also reflects responsiveness. It moves when capital reallocates, not months later. What makes this moment different is that these macro forces are not isolated. They are overlapping. Inflation pressure, currency weakness, geopolitical risk, debt constraints, and market concentration are all reinforcing each other. Historically, when multiple macro tailwinds align, precious metals don't drift higher, they reprice. That repricing tends to be nonlinear, catching many participants off guard. Silver sensitivity amplifies this effect. Because the market is smaller and thinner, it reacts faster to changes in capital flow. When sentiment shifts, silver doesn't wait for consensus. It moves ahead of it. That's why silver often leads during early phases of macro transitions. It acts like an early warning system, signaling stress and opportunity before they become obvious. This is why holders of gold and silver need to view the current environment through a wider lens. Short-term volatility is not the risk, misunderstanding the macro backdrop is. When the foundation of the financial system is under pressure, assets tied solely to confidence struggle. Assets tied to utility and scarcity do not. Silver sits at that intersection. The macro forces now in motion are not temporary reactions to headlines. They are the result of years of accumulated imbalance. Markets are beginning to adjust, and silver is responding accordingly. When macro conditions shift, they don't ask for agreement, they impose consequences. Recognizing that shift early is what separates preparation from reaction. For investors, the most important question right now isn't whether silver or gold will go higher tomorrow or next week. It's whether their current positioning actually reflects the risk environment we are moving into. Markets have a habit of shifting regimes quietly, then punishing those who continue to operate with outdated assumptions. Silver is one of those assets that exposes this mistake very quickly because it doesn't allow much time for adjustment once momentum takes hold. Most portfolios today are still structured around stability, stable growth, stable liquidity, stable policy responses. That framework worked well for a long time, but stability is no longer guaranteed. And when uncertainty becomes structural rather than cyclical, the definition of risk changes. Risk is no longer just volatility. It becomes exposure to systems that rely heavily on confidence and leverage. This is where precious metals begin to matter again. Not as a trade, but as a strategic component. Silver in particular forces investors to confront uncomfortable truths. It is volatile, it is emotional, and it often moves in ways that feel irrational until you zoom out. Those sharp moves are not flaws. They are signs reflecting market that is thin, sensitive, and highly responsive to changes in capital flow. When positioning is wrong, silver doesn't drift, it snaps. That's why waiting for perfect clarity is usually the worst strategy. Another mistake investors make is treating gold and silver as interchangeable. They serve different purposes. Gold tends to reflect long-term confidence in monetary stability. Silver reflects stress, transition, and acceleration. When markets move from comfort into uncertainty, silver often outperforms because it captures urgency. That doesn't mean it replaces gold, it complements it. Balanced exposure isn't about picking one winner, it's about understanding how each behaves under pressure. Risk management becomes critical here. Strategic positioning doesn't mean going all in or making emotional decisions. It means understanding where downside risk actually lives. In environments where debt policy and inflation intersect, downside risk is often hidden in places that look safe on the surface. Hard assets reduce reliance on counterparties. They don't eliminate risk, but they change its nature. That shift alone can materially improve portfolio resilience. Timing is another key factor. Investors often ask for confirmation, but confirmation in markets usually arrives after price has already moved. By then, risk increases and opportunity decreases. The goal isn't to predict tops, bottoms, it's to recognize when probabilities change. Silver's recent behavior suggests that probabilities are shifting, not that outcomes are guaranteed. Positioning early, even partially, allows flexibility. Chasing later removes it. This is also where psychology plays a role. Years of underperformance train investors to dismiss an asset. Silver has been written off many times, and that skepticism is exactly what fuels strong moves when conditions change. Markets don't reward popularity, they reward preparation. When sentiment flips, it flips fast. And those who waited for validation often find themselves reacting emotionally instead of strategically. Another consideration is liquidity. During periods of stress, liquidity evaporates unevenly. Assets that appear liquid in calm conditions can become difficult to exit when volatility spikes. Physical assets and well-structured exposure to precious metals behaved. They are not dependent on daily confidence. That difference becomes meaningful when markets are forced to reprec risk quickly. For long-term investors, this moment is about alignment, aligning expectations with reality, aligning portfolios with macro conditions, aligning strategy with behavior. Silver doesn't require belief. It requires respect for its role, its volatility, and its historical tendency to move sharply when conditions demand it. Ignoring that history is a choice, not a strategy. Ultimately, this is not about predicting extreme outcomes or attaching to specific price targets. It's about acknowledging that the environment has changed and adjusting accordingly. Strategic implications don't announce themselves loudly.